Our final presenter for the day is Jeremy Lang. He's the co-founder of Ardevora, and they're responsible for managing the Nedgroup Investments Global Behavioral Fund. Now, Rob Johnson, he is the head of Nedgroup Investments. He'll be speaking to him about why he feels quite optimistic at the moment. Rob?
Thank you very much, Tumi, and hello to everyone joining us from around the world this morning. Now, there's many reasons to be cautious with your investment portfolio at the moment, with high valuations across asset classes, rising and persistent inflation potential, and also the uncertain evolution of the return to normal post the COVID pandemic. Now, unsurprisingly, our partner Ardevora Asset Management have a slightly different perspective on this. So I'm going to ask Jeremy. Jeremy, why is it that you're feeling a little bit more optimistic than most at the moment?
Rob, three things really. Growth stocks look interesting, recovery stocks look interesting, and there's just a lot of free cash flow out there. So if I pick them off, disruptive growth businesses. There are a lot of interesting kind of growth themes pre-COVID, and COVID has come along and just created this really, really unusual kind of like mass accelerator for a lot of trends, which means we're never going back to normal. And we see this popping up in lots of different ways. Probably a simple stock-specific example for us amongst the many stocks that we have is a business called C Limited. It's very similar to another business we own called Shopify. They basically produce like an e-commerce shop in a box for small businesses in Southeast Asia. Already doing well pre-COVID. We know people more prepared to shop online, but COVID's given that a massive boost. They provide this sort of toolkit and almost like an operating system for you if you want to set up and run and then scale an e-commerce shop. Normally what happens in a recession is small businesses go under, and not many of them are created. In this period, the opposite has happened. It's a kind of like a complete 180 for that kind of business. People are expecting demand to fall off a cliff. It's done the opposite, and so that's just not going away. And there are lots of other examples like that, I think, which tell you that this idea of return to normal is not going to happen. Same for recovery businesses. This has been an off-the-page kind of shock, which has forced a lot of businesses to really have a hard think about what they're doing. And again, we've got lots of examples of this. But in conventional retailing, we've got a business called Capri, which has brands like Michael Kors and Jimmy Choo and Versace. Their distribution channel was completely shut down during COVID. It was already struggling before that, department stores. So they basically just had to kind of tear up the playbook and start again. Embrace e-commerce, completely rethink about the supply, and basically nothing off limits. And so that breadth of what they've been prepared to do with the business is again just off the page, and that's really extraordinary, I think. And then the final thing is that a lot of this accelerator has just made businesses a lot leaner, and so they've been able to throw off tremendous amounts of free cash flow. Returns are kind of exploding everywhere, and there's almost like there's just too much capital out there, and we can see this with bond yields, incredibly low. There's liquidity everywhere. So I put all those three things together. This is a very, very unusual environment for a kind of classic recovery cycle.
You finished on the word unusual there, Jeremy. But, how is this different from before? What things are you seeing that's making it more interesting or more unusual for you?
Yeah, so this for me, this is not your standard recovery where something comes along, it knocks the economy sideways. Everybody worries about the end of capitalism, whatever, and then the government steps in. And then investors are somehow surprised by that, and then they think it's a fiddle. If you like, the government comes in, bails everybody out, prints lots of money, recovery kicks in, and then the the game moves on from the investors now. They worry about what's going to happen when, if you like, the government takes the life support away. That's a really common kind of recovery cycle, but this is so different because of what caused this in the first place, that COVID shock. It's like, necessity is the mother of invention here. What really catalyzes enterprise and invigorates economies is when you get this sort of widespread shock, which forces everyone to rethink how they should do things. And that's what COVID's done. It's been this huge accelerator of a focus on efficiency, doing things in a different way. And so the whole way the global economy is structured has been rethought, and a tremendous amount of potential, I think, has been unleashed through that, which has been kind of going on underneath that idea of government steps in, bails everyone out, recovery comes through. What happens when the government support disappears? I think the whole structure of the global economy has fundamentally changed through this process, and that's tremendously exciting.
There's a number of things there that make me think there are some risks still out there, and you're usually quite risk averse in your approach to investing.
Yeah, what we worry about is over-optimistic CEO behavior, and that generally comes about when you've got your CEOs cruising along. They think they're God, they think their businesses are special, and then they take big bets on big themes, and they overpromise and underdeliver. Generally, the closer you are to an unpleasant shock, the safer it is in the way those people behave, because they get scarred. The handbrake can go on if they've been through a period where life is much tougher than they expect, and they can be unusually humble for a period until they get further away from that last shock. And it was very similar in the aftermath of the GFC. You had a whole group of CEOs who normally you'd be distrustful of, went through this period for 3 or 4 years where they kind of more behaved themselves, and that gave you a very favorable backdrop before they reverted back to type. And pretty simplistically, very similar playbook, I think. I think CEO behavior, like all of our behaviors, is shaped by your experiences. And if most of the time you're risky, but you've been through a period where you really feel the risk, it modifies your behavior for as long as you remember that anchor, that scar. But then the further you get away, the more it fades again. And we're in that. You can still remember the trauma. You still worry about what normal is. You worry about extrapolating the good times. And so it puts the handbrake on your normally reckless behavior, is my very simple take. And so I think there are times where, if you feel that, where it's right to trust what CEOs are telling you, and the vast majority of them are telling us that life is unusually easy, but somehow they don't really trust it either. So you got that from below, but from above, I think that the overwhelming narrative is this is a normal recovery. And what's going to happen when the government pulls out the support because somehow they fiddled it? They're propping up markets. And so we can really see this in the way stock markets have behaved this year. And the way analysts have behaved as well. We've had now 2 consecutive quarters of blowout results from companies where analysts have been forecasting a recovery, but the rate and the pace and the degree of the recovery continues to catch people out. So you see that in record sizes of surprises and record number of surprises. So we know the forecasters are wrong. They're too skeptical about the recovery. And at the same time, investors are not strangely, because for me it fits the standard kind of where we are in the recovery cycle, but they're skeptical as well. And you see that because the stock prices have been quite resistant to that good news. And so stock prices have gone up a lot less than that very powerful recovery and surprises that have gone through. And so valuations have compressed a lot. So people worry a lot about valuation levels, but for me, I'm much more interested in that path through time. That tells me about skepticism. And I see a pattern which suggests a lot of skepticism, a lot of this narrative of this is as good as it gets, it can't continue, what happens when the government pulls the life support away. But as I say, if you look down below, boy, there's a lot of structural change going on, and really exciting structural change.
Jeremy, thank you very much for joining us today. I appreciate your time.
Yep, thanks, Rob.
So what you heard from Jeremy was we have disruptive growth businesses which are seeing unusual opportunities that perhaps weren't there before. You're seeing businesses that are recovering and taking decisions to restructure that they may never have been bold enough to do before. And coupled with that, you're seeing an immense amount of capital in the system and a high liquidity that's growing into growing businesses, growing all asset classes around the world. So it's many reasons to be cheerful there. So I hope you'd agree. I found some of that content extremely interesting. Thanks very much.
Well, thank you so much, Jeremy and Rob.